So moving into the uranium space, Denison Mines, we're a uranium developer and exploration company in the Athabasca Basin in northern Saskatchewan. What you're looking at on the screen there is a view of the road that actually connects up to the eastern edge of our property, our flagship property, Wheeler River, right between the McArthur River Mine and the Key Lake Mill, which is well known as the world's largest and highest grade uranium mining operation in the world. Of course, I'm going to be making some forward-looking statements here, so you'll certainly want to refer to this cautionary slide as you're doing your homework on the company. First, just a few quick remarks on the uranium space. This is it's a highly cyclical commodity. Of course, they're all cyclical, but the uranium cycle is quite a long cycle. And I've just got a few themes here on the slide that I want to touch on just ever so briefly here. We have certainly seen the demand story improve. For a number of years, that's actually been a negative in our space, post the Fukushima tsunami and nuclear incident. But we are actually seeing demand actually return to a growth profile, which is very positive. At the same time, we've seen significant supply curtailment over the last 3 years, and that's fundamentally what's driving the market to a better place. We've seen the largest and highest grade mine in the world, McArthur River, curtailed indefinitely. We've seen high-cost mines reach end of life and basically drop off. And we've seen the lowest cost producers in the world, the Kazakhs, actually trim their production as well, recognizing that a $24, $25, $30 uranium price isn't economic for even the best and lowest cost producers in the world. Now, Denison's story is really informed by the market. Our strategy is around advancing Wheeler River to production so that we can actually be producing at a time when the long-term contracts in the space run off and demand from the utilities actually comes back into the market. Now, there's a lot in that concept because demand broadly is improving, but purchase demand is driven by contracting and the contract cycle. And this figure on the slide is really just highlighting how utilities are covered in the near term, but that cover drops off quite quickly. And really this is the key part of the story, is that we're going to see the price start to move as the utilities come back into the market and fill up their long-term contract books. Importantly, we want to be in a position to be able to sell those pounds. Now, that's a bit of a conundrum. Because if the price is low and your asset requires a higher price, then how can you really justify moving forward? And I've got a bit of a story on that as we go through the rest of the presentation, because I think we're really uniquely positioned to be able to actually make that decision today, because our Wheeler River project and the Phoenix deposit has the potential to make money even in today's low-priced market. So quickly, and this is a bit of an overview on the company, and we certainly invite follow-up at the rest of the conference here. The company on one page, diversified asset mix focused in the Athabasca. Our flagship is a 90% interest in Wheeler River. This is a development stage project. It is the largest undeveloped uranium project in the eastern portion of the Athabasca Basin, and we have initiated the permitting and environmental assessment process, so this asset's moving forward. We also own a 22.5% interest in the McClean Lake mill, which is shown on the screen. This is operated by Orano and is currently processing all of the ore from the Cigar Lake mine under a toll milling contract, one of the largest processing plants in the world for uranium. Real asset, exists, permitted, and has excess license capacity. We have other assets, interests in undeveloped uranium deposits in the region, and we have a wide range of exploration assets that we continue to work. We also generate some cash flow from an environmental services business that we have operating and taking care of our own closed mine, as well as a number of closed mines for BHP in Northern Ontario. And we manage a company called Uranium Participation Corp. This is a company that has a physical stockpile of uranium traded on the TSX under the symbol U. Gives you clean and lean exposure to just the commodity. Denison has a contract to operate that company and carry out the commercial aspects of it. Quickly here, navigating you around the Athabasca Basin. Remember, this is in northern Saskatchewan, and that's very much in the center of Canada. very close to our Northwest Territories, so it does get quite cold in the winter. You're talking negative 40 degrees Celsius, but that's actually great for exploration and work up there because the ground gets quite solid. The asset that we're going to focus on for the rest of this presentation is Wheeler River, and you can see that call out there, located right between the McArthur River Mine and the Key Lake Mill, right along that road and power line that we saw on our cover slide. We put a pre-feasibility study together for Wheeler River about a year ago. It was quite a dramatic result. We have two deposits on this property. One is the high-grade Phoenix deposit, and the other is the Griffin deposit. The highlight was the selection of the in-situ recovery mining method for Phoenix. This will be the first ISR mine in the Athabasca Basin region, and it's been quite a powerful combination of taking a very low-cost mining method, an ISR, lowest cost mining method for uranium in the world, and pairing it up with Phoenix, which is actually the highest grade undeveloped uranium deposit in the world. That's how we can produce OPEX in the range of $3.33 a pound US, and that's how we get those all-in costs, and all-in costs of under $9 US. That, just to be clear, that's upfront capital, operating costs, and sustaining capital for the whole project. Add it up, divide by the number of pounds, and you're coming in under $9. That's really the point, right? That's why we can invest in this project today, because it actually has a $17 margin at today's spot price. Griffin adds good scale, and that project is an underground mine. It's not ISR amenable. We've got good operating costs there, but we do have significant capital associated with sinking shafts, and so that's why you end up with an all-in cost in the $23 range. Whole project gets started with around $323 million Canadian in CapEx to get Phoenix off the ground. Where do we position this in the global cost curve? And of course, you've seen many of these cost curves for different commodities, and I'm sure you'll see them for uranium as well. But Phoenix really does have the potential to be the lowest cost producing asset in the world. It competes very well with even the lowest cost assets in Kazakhstan. Our Griffin operation competes quite well with McArthur River, Cigar Lake, other existing Athabasca operations. Project comes together in a staged approach. We have a reasonable view of the market. This is a commercially informed strategy of developing the Phoenix deposit first, and then using the cash flow generated from Phoenix to fund that Griffin operation. We don't see the utility in producing 15 million pounds a year in 2025. The uranium market may not need those pounds in 2025. The Phoenix pounds will make money in any market, and so we're happy to move that forward on an uncommitted basis without having contract cover, and then bringing on Griffin in a staged and sensible manner to add scale to the project. So right now we are in the middle of the environmental assessment and feasibility study support work programs that are required to move Phoenix towards a development decision. Then we have the prospect of 10 years of mining at Phoenix, 6 million pounds a year. Would make us one of the largest uranium mines in the world, but wouldn't destroy the entire uranium market. 6 million pounds is meaningful, but it's not a dump into the uranium market. And then we add that Griffin operation for scale and longevity. Last slide here, just on economics. Really want to highlight two elements to this. The base case scenario. It really is a reasonable scenario, again, commercially informed. We have modeled the pounds at Phoenix being sold using UxC's spot price deck. So the first pounds at Phoenix are sold in the range of $29 US a pound. That's lower than anyone in the industry has used in any economic model, and very close to where we're at today. We've actually been north of $29 within the last 12 to 18 months. So we've given up NPV to do that, but we're doing it to prove that this project is economic today and it justifies deployment of capital to move it forward today. We're using a $50 spot price or $50 contract price at Griffin, and that's meant to reflect the fact that we see that more adequately covered by contracts. Altogether, significant increase from our PEA from 3 years ago. We're up almost 200% from where we were in that PEA, and that's owing in large part to the change in mining method at Phoenix to the ISR. Look, that's it from me. Just a photo here to wrap up with some of the test work that we are doing this year at Phoenix as we start the process of de-risking the ISR mining method. Anyways, we'll certainly be around for the rest of the show and encourage everyone to come say hi and ask about more of this ISR test work. Yeah, so the question is just a comment on the difference between contract and spot pricing. Yeah, right now, so you're around a $26 spot price and around a $30, $31 contract price. That's that's still a reasonable spread, but most of that is reflecting, in my mind, just the cost of capital. If you look at sort of the 5-year forward price on the spot market, you'd see something in that range of $30, $31. So there's not really a premium right now on that term price. Okay, perfect. Thanks so much.